Welcome back to our course on FinTech risk management. In this session today, we're going to be talking about strategy and technology for implementing corporate governance. Now, when we think about this, one of the risks that we're dealing with in FinTech is business risk. Why? Because FinTech changes the rules of the game. It's inherently disruptive. It's inherently a new business, and so it's changing all of the rules. And sometimes regulations are changing the rules. They're changing the way firms work, like MiFID 2. Now you might say, what the heck is that? Well, it's a variety of things, but mostly it says you can't bundle finance research in with finance transactions or fees. So you can't pay for your research in equities as an investment bank by sort of bundling it into your fees for other things with clients. You have to get people to pay directly, and that means many equity firms, trading firms, are no longer doing research. That means jobs are going away. That means rethinking industry structure, and so it's disruptive. And it changes the rules of how we compete. When you unbundle things, that puts pressure on traditional structures. It puts pressure on jobs. It means that people have to look for new ways of competing. And it might mean moving things to online context, or paying for things separately, or finding values in new ways. And some FinTech firms will take advantage of that as an opportunity. They'll also take advantage of the unbundling by charging less or providing better services in some ways through disintermediation. Sometimes FinTech directly affects things and competitiveness, like Berkeley Coin, for example. Now, many people who love cryptocurrencies don't like Berkeley Coin because Berkeley Coin is a tethered currency. This is an ICO that is tied to the US dollar. There is no speculative gains. There's no big upside. It's just a digital currency like PayPal or like Apple Pay. It's not a cryptocurrency in the sense of wildly gyrating prices. But it is interesting in that it's a digital currency that could be used as payments, and it's a way of raising capital. Berkeley is using this coin idea to do a legal IPO, to do a legal securities issue, complying with all securities laws, all U.S. securities laws. And they're saying, well, we're fine, we're a security. Yep, regulate us that way. But we're not using Wall Street. We're just going to go directly to the people, directly to the citizens of Berkeley, directly to individual investors and say, would you like to buy a virtual municipal bond that has a small increment? Instead of needing to buy $5,000 minimum, we'll sell you $50 or $5. You can buy a small amount and help fund the park in your neighborhood, help fund the fire department. Spotify did something interesting in that instead of going IPO using Wall Street, they said, we don't need to raise capital from Wall Street. We don't need money from Wall Street, but we want to be listed on the stock exchange. Normally, the way you get listed on the stock exchange is you do an initial public offering, you raise some money, you sell some stocks, and Wall Street makes some money, and investors make some money, and everybody gets excited. Spotify said, nah, we're just going to list on the stock exchange. We're just going to do a direct public listing, and we're going to bypass Wall Street. We're not going to raise any money. We're not going to pay any fees. We're just going to list. And some people said, well, but how do you know what's the right price? How do you know what it's worth? Well, how do you know what any security is worth? It's what a buyer and a seller will pay for it. And it's a market price based on supply and demand. The IPO simply sets a starting price, and then you could buy at that price if you get in, if you're lucky enough to buy with the IPO, and then maybe it'll go up. Spotify said, don't need all of that. We'll just go to the direct list, and we'll allow people to buy and sell. We'll create liquidity without using Wall Street. Now, so not a big deal. Well, it is a big deal if you're Goldman Sachs. It is a big deal if you're in the business of IPO, if you're in the business of making money from people going through you. This disintermediation is a big deal. E-loan disintermediates banks, allows investors to buy a piece of a loan without buying a bank CD, which is a piece of a loan or portfolio of loans of the bank. You're now directly investing in a portfolio of loans. There are many other such lenders. This is bypassing or disintermediation. And that's a lot of what's happening in fintech, is allowing us to disintermediate financial institutions, and that creates risks. If you're a bank, if you're an insurance company, you'll look at this and say, oh shoot, what used to be bundled is becoming unbundled. Sometimes regulators are going even more directly towards unbundling, like the UK, saying we want to unbundle banking and open up the data. We want you to be able to, not just able to, but required to, as a bank, share data on payment history, transactions, income, expenses over time. You should be able to take your account with Citibank and take it over to Wells Fargo and transfer all the data about that account with it. That's the idea of open banking API, and that can be as dangerous to a bank as is opening up an API on a software application. It opens up competition. It opens up new opportunities. It's a way of deregulating. Politics can also create business risk for financial institutions. For example, in Hong Kong, HSBC, Hong Kong Bank, had a monopoly on ATMs in the MTR. MTR is Mass Transit Railway, or in the US lexicon, subway. The train system, the underground system, using UK terminology. But in the underground, the subways, the trains, HSBC was the only bank that had ATMs. And that was good for HSBC because most people go through the MTR, the Mass Transit Railway, subway, or underground, sometime during the day. And therefore, being the only bank with this option of getting cash easily in this most common, most public of places was a big advantage. That was due to a relationship. Now, with the handover to China of Hong Kong in 1997, this became politically untenable to have the MTR, a government-associated entity, only allowing a British firm, HSBC, to have access to ATMs in the MTR. And so they opened it up to Bank of China. Now, that doesn't sound too bad because, oh, now we have two banks in the MTR. But Bank of China shares a network with open API, effectively with all other banks. The ATM network that Bank of China uses is used by every other bank in Hong Kong. So that means hundreds of banks can now have access to a wide range of ATMs across all MTR stations, and many other places Bank of China allowed virtually everywhere. That opens the door for competition. And so when a government declares we're going to deregulate, whether it's electricity, whether it's telecom, whether it's banking, doesn't matter, it's going to create business risk. And if you don't understand that, take a look at telecoms or take a look at electric utilities and see what's happened over time as we deregulate markets. It's a big deal. And we are facing deregulation and disintermediation in finance. That's business risk. And it's a bigger risk than banks are used to acknowledging. And particularly for fintech firms, it's inherent to the nature of fintech is business risk. Thank you.